Welcome to SG Investment. Our channel is dedicated to helping you make informed decisions about your money and to guiding you on your journey towards financial success. Subscribe now and join our community of like-minded individuals on the path to financial freedom. Warren Buffett Investment Principles. Warren Buffett, often referred to as the Oracle of Omaha, is one of the most successful investors of all time. He is the chairman and largest shareholder of Berkshire Hathaway, a multinational conglomerate holding company, and his net worth is over $100 billion. Here are investment principles can be learned from Warren Buffett. 1. Invest in what you know and understand. Warren Buffett believes that investors should only invest in companies or industries that they understand well. By investing in what you know, you are better able to evaluate the prospects of a company and make informed investment decisions. This principle is often referred to as circle of competence, which means that investors should focus on the areas where they have knowledge and understanding and avoid investing in areas where they lack expertise. 2. Look for companies with a strong and durable competitive advantage. Buffett believes that companies with a sustainable competitive advantage, also known as an economic moat, are more likely to generate consistent and predictable earnings over time. A strong competitive advantage can come in many forms, such as a strong brand, patents, or a unique business model. Companies with a durable competitive advantage are better able to fend off competition and maintain their market position. 3. Invest in companies with consistent and predictable earnings. Buffett looks for companies that have a track record of generating consistent and predictable earnings. This is because such companies are more likely to continue generating consistent returns in the future. He also looks for companies that have a high return on equity, ROE, as it is a measure of a company's profitability and efficiency. 4. Look for companies with low debt and strong financials. Buffett focuses on companies with strong balance sheets and low debt. Companies with low debt are less exposed to financial risk and are better able to weather economic downturns. He also looks for companies that generate free cash flow, which is the cash a company generates after accounting for capital expenditures. 5. Invest in companies with strong management teams. Buffett places a lot of emphasis on the quality of a company's management team. He believes that a strong management team is critical for a company's success and that a company's management should be aligned with the interests of shareholders. He also looks for management teams that have a track record of making smart business decisions and creating value for shareholders. 6. Be patient and willing to hold investments for the long term. Buffett is known for his long-term investment horizon and encourages investors to be patient and hold on to their investments for the long term. He believes that the stock market is a vehicle for transferring money from the impatient to the patient. By taking a long-term view, investors are more likely to reap the rewards of compounding and are less likely to be swayed by short-term market fluctuations. 7. Avoid trying to time the market. Buffett advises investors not to try and time the market by trying to predict when to buy or sell stocks. He believes that it is impossible to consistently predict the short-term movements of the stock market and that investors are better off focusing on the long-term fundamentals of a company. 8. Diversify your investments. Buffett advises investors to diversify their portfolios by investing in a variety of different companies and industries. Diversification helps to reduce risk by spreading investments across different assets, so that a loss in one investment is offset by gains in others. 9. Don't overpay for a stock. Buffett is a value investor and believes that investors should only buy stocks that are undervalued in relation to their intrinsic value. He advises investors not to overpay for a stock and to only buy stocks that are trading at a discount to their true value. 10. Continuously monitor your investments and be willing to sell if a company's fundamentals deteriorate. Buffett advises investors to continuously monitor their investments and to be willing to sell if a company's fundamentals deteriorate. By monitoring a company's financials, management team, and competitive position, investors can identify warning signs of trouble and make informed decisions about when to sell an investment. Conclusion. Warren Buffett is one of the most successful investors of all time, and his investment principles can be learned from his approach. His principles include investing in what you know and understand, looking for companies with a strong and durable competitive advantage, investing in companies with consistent and predictable earnings, looking for companies with low debt and strong financials, investing in companies with strong management teams, being patient and willing to hold investments for the long term, avoiding trying to time the market, diversifying your investments, not overpaying for a stock, and continuously monitoring your investments and being willing to sell if a company's prospects change. By following these principles, investors can potentially make informed and profitable investment decisions. Thanks for watching. Don't forget to like, comment, and share.